Let's continue with our Chapter 5 lecture. In our last transaction, we estimated that $200 or 2% of our revenue will become uncollectible. When recording that transaction, the allowance for doubtful account, which is a contra asset, went up by 200, but it's shown as a negative number, and retained earnings decreased by 200 because this amount is shown as uncollectible account expense. So now we have a summary of our transaction that took place for year 2. Here we're showing the income and expenses on the income statement and our net income amount. Here we're showing the assets on the balance sheet, and we're showing the impact of those transactions on our statement of cash flow. On this next approach, we're going to focus on receivables in order to estimate the uncollectible account expense. In the previous examples, we use revenue to do the adjustment, but now we're going to look at receivable in order to estimate our uncollectible account expense. Now, let me say this. The receivable method is different than the percentage of revenue. When we did the percent of revenue, the amount that you calculated was your uncollectible account expense. But with the percent of account receivable approach, you're now focused on the ending balance and the allowance for doubtful account. So again, it's a different approach. With the receivable approach, we're now focused on the ending balance and the allowance for doubtful account. And I'll explain what I mean with some examples. Let's assume that we got a company called Pyramid Corporation. The account receivable account, the balance of $56,000, and the allowance for doubtful account has a balance of 500 in that account. Keep track of that. They estimate that 6% of his account receivable will become uncollectible. Now, with the percent receivable method, your focus is to determine what should be the ending balance and the allowance for doubtful account. So we're saying that the allowance for doubtful account and the balance should be 6% of our receivables in the balance, which is $56,000, right? So if you take 6% times $56,000, that gives us $3,360. However, there's a balance of 500 already in the allowance for doubtful account. So to get the amount of your expense, subtract the 500, what's in there already, from your desired ending balance 3360, and that gives a difference of $2,860. This 2860 here is now, where's my marker? Here we go. This 2860 is going to recognize or is going to be recorded as your uncollectible account expense. Again, with a receivable approach, you're trying to determine what should be the ending balance and the allowance for doubtful account. That amount should be $3,360. However, you have an account already $500. Therefore, to get from 500 to 3360, I need to increase my expense account by $2,860. Okay? Now, another approach dealing with receivable is based upon the age of our receivable. So we're saying in total, our clients owe us $56,000. Again, in total, our clients owe us $56,000. Let's break that down. Of that $56,000, 26,500 of that is current. 11,700 of that is between 0 and 30 days past due. 13,100 between 31 60 days past due. 3,000 is between 690 days past due, and 1,700 is over 90 days past due. Perhaps you're saying, okay, why do we break it down to what we call different aging categories? I'm glad you asked that question. The reason being, as an account becomes older, the harder it becomes to collect. So now we're going to assign a percent to each aging category, but notice it's a different percent. The percent amount is going to increase as the account becomes older. And that's because the older an account becomes, the harder it becomes to collect. So now we're going to multiply the amount in each category times the percent that was assigned. When you add those all together, this gives us the desired ending balance and the allowance for doubtful account. So now we're saying the allowance have an ending balance of $3,760. Remember, the account had a balance already of $500 at the beginning of the period. Therefore, our expense amount we're going to recognize is going to be the difference of the $3,260. So again, the 3760, this is going to be the desired ending balance and the allowance for doubtful account. The account has a balance already of 500, so the difference of 3260 is recognized as your uncollectible account expense. Okay? So when it comes to recording this expense, you can use either approach, the percent of revenue method or the percent receivable in order to estimate your uncollectible account expense. Okay? Our next topic focus on notes receivable and accrue interest on notes receivable. So we talked briefly earlier that when you have an amount that's owed from a client and the amount may be substantial or the terms could be for a longer period of time. So now rather than paying 30 days, we may give them 180 days to pay. When that takes place, often we make them sign what's called a promissory note. In case there's a dispute, we now have written evidence of the terms between this agreement between those two parties. All right? So if you're asking what's a promissory note, well, let me help you. If you have student loans, you sign a promissory note. If you have a car note, you sign a promissory note. If you have a mortgage, you sign a promissory note. This is a written document and agreement between two parties. For example, let's assume that the company loaned to Stanford Cummins 15,000. Ooh, a lot of money. They loaned this person $15,000. All right. So this the date, November 1st, we'll say 2024. It shows the amount 15,000. It is payable on October 31st of the next year. Okay? The interest rate being charged is a rate of 6% per year. The Stanford person put up their title to the automobile as collateral, meaning that if they don't pay back the $15,000, then the tutoring service can take ownership of that vehicle for non-payment. Okay? So the note has a maker, the person who's actually making the note, the payee, the person who borrowed the money, the principal is the amount that was borrowed, the interest is the amount that's going to be received for the benefit of receiving those funds. Maturity date is when the payment becomes due, and collateral is an asset that has been signed as security in case there's a default on the repayment of the actual note. Okay? So when they loan that $15,000, we're now on the balance sheet for ATS, the tutoring service. their cash decreased by $15,000, but the notes receivable account increased by $15,000. It doesn't impact the income statement, but statement of cash flow, there's an outflow of $15,000 as an investing activity. Now, this note has an interest rate of 6%. Interest rate of 6%. All right. So we're going to look at the amount of interest that has accrued on this note by the end of our accounting period. So the note was issued on November the 1st. Our accounting period ends on December 31st. From 11/1 to 12/31 is a 2-month time period. Now, this 6% is the annual interest rate, the rate for an entire year. But this note has only been outstanding for 2 months by the end of our accounting period. So we must determine the amount of interest that has accrued on this note by the end of the current accounting period. Interest equals principal times rate times time. The principal amount was $15,000. The annual rate is 6%, and the time factor is 2/12. Therefore, the accrued interest equals $150. Now, we won't receive it just yet. We're just recording and recognizing the amount of interest earned and owed to us by the end of the accounting period. So you're going to recognize interest receivable. Under your assets, you have interest revenue, which will increase your retained earning. That'll also impact your income statement. This is what we call an adjusting entry. It is to update our accounting records at the end of the year before we prepare our financial statements. Okay? So now, when the note becomes due, along with the accrued interest, so remember, the amount borrowed was $15,000. The interest rate was 6%. The total interest is $900. So when they pay us the note back, they must pay us the $15,000 they borrowed plus the interest for a total of $15,900. Now remember that 2 months of interest was already earned and recognized in year 1. So here in year 2, we'll recognize and record the remaining 10 months of interest, which totals $750. So from a revenue standpoint, the interest owed in year 2 is going to be $750. You recognize interest receivable. You're going to recognize interest revenue for $750, which will increase your retained earnings account. So now it's payday. It's now to get paid by the actual client. So when a client pays us, we'll recognize cash for $15,900, decrease no receivable by $15,000. We've been paid now, and we're going to decrease interest receivable by the $900 because both the principal amount and the interest have been paid back to us. On our statement of cash flow, we're going to recognize an increase in cash of $15,000 from our investing activities and an increase of $900 for the interest as an operating activity. Okay? This is some good stuff, isn't it? Yes, it is. So come back. We'll cover a little bit more about receivables and then move on to inventory. So stay tuned for our next Chapter 5 video. Bye-bye.